Hello and welcome to India Market Open. It's midweek, guys. It's going to be a sideways sort of day of trade. We've got the big event lined up tomorrow. I'm guessing traders would choose to be on the sidelines, even though we have positive cues from the rest of the world.
Mixed cues, I would say. But yes, everyone is wait and watch. This morning in US markets, they're waiting to see what the Fed will do. We're, of course, waiting to see what our finance minister will do, and, of course, a lot more. So exciting.
Yeah, and Tamanna, Samina, good morning to both of you. Very likely that if the Fed overtakes everything else, then the markets will probably dance to that tune, because the budget, if they don't do too much on the fisc side, etc., and we'll talk about that, I'm sure, tomorrow, might well turn out to be a bit of, hopefully, from a market-wide perspective, a non-event.
And the texture is a buy on dips market. So I'm thinking
for now, yes,
the positive cue is what the markets will want to hold on to. GIFT Nifty, though, yesterday was also a bit of a late sell-off in the last hour of trade. But yeah, you take it from there.
Yeah, absolutely. Muted start as far as the Nifty is concerned and the implied open is concerned. But let's be clear, no rate cut is expected by the Fed at all. I mean, 97% of those polled in at least one survey says no rate cuts, and this is not the rate cut meeting. What's going to be seen very closely is the commentary and whether the Fed is now willing to start looking at cuts further down. And is it going to be as early as March? That has been the key concern. So like I said, mixed kind of cues for the US markets. NASDAQ weighed down by tech results. And the big ones, of course, came in after markets closed on Wall Street. They were disappointing. And Alphabet numbers, other numbers, all looked, even Microsoft, hit the mark in terms of the expectations, but when you go into the details, were a bit disappointing. For Alphabet, it was the ad revenues, which has seen pain. The 10-year has also slid 4.036%, so well below the 4.1% mark where it was hovering. That's ahead of cues. Jobs data, which came in yesterday in the US, was also quite hot. So again, no clarity yet on which way the Fed and interest rates will move. That kind of mixed and confusing situation continues with oil. You have Middle East tensions on the one end. On the other hand, you also have IMF data, which tells you that economies are going to be doing even better in the US and in China. So all in all, you've seen a bit of pressure there building on NYMEX as well. So global cues are mixed. The stage is really set for what happens here. I'll just quickly pick up fund flows before I take it to Niraj for the trade setup of the day. And this is interesting because foreign investors actually turned after 4 trading sessions in a row and ended up buying yesterday, not monumental amounts, but about 1,086 crores, while DIs were the sellers. Here, it's all about the numbers as well as what stacks up tomorrow. You know, Niraj, I just want to say, for all the talk about this not being such a big event, there's a lot hinging on it, isn't it?
Yeah, I mean, no, relative between the two, I'm saying that if the Fed really overtakes, then it may reduce the budget to be a bit of a non-event for the market-wide perspective, because the Fed may be the overarching piece. And just a moment to mention, but we're seeing, Tamanna is right, we're seeing budget-induced volatility for sure, because VIX yesterday ended at the year highs, the financial year highs. And that is telling something. 16.1 for the VIX. So volatility certainly, we are not used to this. And this is presumably because of the fact that there is the Fed speak plus the big budget tomorrow. Sharp downside in trade seen yesterday. The only respite to my mind is that we closed about 21,500, if that is any leeway, but because that is being seen as that level. I mean, we may go to 21,300, but then we recover and then stage about 21,500. So for whatever it's worth, closing above that level might be a bit of a positive. But there is a looming risk of Fed speak not being dovish. Now, there are various publications, including Gavical, including Greed and Fear, which have all spoken about the possibility that what if the Fed dashes the market hopes of a rate cut in March, because that is what it is all about. Whether it's March, whether it's June, whether it's beyond, does the Fed indicate in any fashion? But even if it doesn't, and if it is not dovish but hawkish, then that might be a problem for markets worldwide, and it may show in our markets as well tomorrow. So that's something to keep a keen eye out for, and therefore it's advisable to be cautious on longs currently. And just from a sector perspective, consumer durables numbers look very, very skittish. I know we spoke to Havells earlier, and the RAC division out there didn't do that great either. Look at Voltas, look at Johnson Controls, Hitachi. It's just looking very, very tough on the pricing front for these guys. So a sector to certainly watch out for.
Indeed, there is enough and more activity. A quick check on how the GIFT Nifty is looking. Like we've indicated, it's a muted start, so don't expect fireworks in early trade. Yesterday, of course, we made a high of 21,813. Now, that is going to be an important level of resistance as well, like Niraj has indicated. Flat to lower opening is what we are expecting. There will be lots of stocks on back of earnings. I will take you through a few of them that you want to watch out for on back of market cap. So you've got L&T, Dr. Reddy's. Those are the two on my radar this morning. L&T numbers, revenues came marginally higher than expected. Margins, though, came in lower than expected. They also have declined year on year. So they've come in lower than what the street was expecting at 10.4 versus 11.2. That was a Bloomberg estimate. And 10.93 is what they posted last year, in the same quarter last year. Order inflows are up significantly by 25% year on year, so no surprises there. Brokerages do believe that the fourth quarter will remain an important quarter to watch out for. Seasonally, this is a quarter when companies like L&T see huge order inflows. But given that you've got elections down the corner, this may not be a very exciting quarter for L&T. Apart from that, L&T is poised to benefit from India's growth story, and that's what big brokerages like Citi are indicating. All in all, numbers in line, but margins are a miss on L&T. Dr. Reddy's revenues have come in higher, EBITDA's improved, margins have also improved marginally, net profits come in high by about 11% for the same quarter last year. Well, the key takeaways, 28% EBITDA margin is what we've seen for Dr. Reddy's. Revlimid contribution has increased more than what brokerages had anticipated. Gross margins, though, remember, remain slightly more muted. Their core generic business is trending low, so that's what you want to keep in mind. The margins of their growth for their generic business is a little bit of a soft spot for Dr. Reddy's. Aggressive plans are looking to launch 26 products in between 2025 and 2027, and they also submitted a response to the recently raised issues in terms of Form 483, and of course their first biosimilar product launch is expected in calendar year 27. So that's Dr. Reddy's. Again, no major surprises there. Margins have improved, so you will see this company may be reacting positively to its earnings. One disappointment was VIP Industries, a huge cut on top line and bottom line. Revenues have come in marginally higher at 3.8%. What is disappointing is margins have declined 429 basis points to come to 9.5 versus 13.86. Remember, VIP historically has maintained margins around the 13 to 14% range. So this is much lower than what we've been comfortable seeing for VIP Industries. Profits have declined about 84%, largely on back of other expenses. When I say other expenses, I'm talking about e-commerce and freight costs. Not sure whether the freight cost has got to do anything with the Red Sea, but it's one thing we will try and understand from the management whether or not these other expenses are going to be one-off or recurring in nature. VIP, most certainly, Tamanna and Niraj will be getting a thumbs down this morning.
Yeah. So there are some who are going to get a thumbs down on their numbers, and there are some who are definitely going to get a thumbs up, possibly on the back of numbers. Cochin Shipyard could be one of them. Blockbuster set of numbers. Very solid Q3. It's a beat on all fronts. Profit has doubled in this quarter. Margins are up over 6%. Just look at the numbers there for a bit. Your revenue is up 64%. Your EBITDA is up 109%. Your margins have shown a considerable growth over there to about 29%, and net profit is also up. So what has worked for Cochin Shipyard? Your costs have come down. Your COGS has come down. Your finance costs have also come down sequentially. Remember, this is also the quarter, and it's been reported consistently where they've seen a lot of defense orders coming in, though the revenue growth has been led by the ship repair part of the business in total, which has seen a 68% increase. The order book also has seen a decent step up Q on Q, about 2%. Another one in that list would be Piramal Pharma. Good numbers over there as well. Revenues up 14% year on year in this quarter. Look at the EBITDA. There has seen quite a bit of increase over there at 268 crores versus 87 crores. Margins have seen a healthy bump up, about 861 bips for margins, and net profits have come actually into the positive versus loss of about 90 crores. So that EBITDA growth is coming from operating leverage, reduce in raw material costs and energy prices, etc. Operational excellence as well. So Piramal Pharma, one to watch out for. The other one I would mark is maybe Z. For some reason or the other, the stock is always in the news. The arbitration begins today, as we reported yesterday. So in Singapore, you have that arbitration where Z goes to court and says, I will not pay that $90 million fine that you want. Meanwhile, they had to come out in the evening in a statement and say that we have no official word that SEBI is investigating us. That was a report. That SEBI investigation reports comes from an interview Subhash Chandra had given to newspapers over the weekend, where he said, I'm going to increase the promoter stake to 26% from the current 4%. Z has come out and said that these statements do not reflect the board. So more confusion surrounding Z, but that's a stock which moves quite fast either way, up or down. Yeah.
Now just two more stocks. One of them is Ganesha Ecosphere. The QIP has been launched at a discount of 6% to the current market price. So watch out for that one. If it has a reaction, you know why. And the other one is Voltas. Revenues were up 30%, which is fine, but margins down 273 basis points at 1% versus a Bloomberg estimate of 4.7%. And that is the problem. And the net loss, therefore, of 27 crores versus an estimated profit of 84 crores. And by the way, just this whole RAC piece, there is a Nirmal Bang note on Johnson Controls Hitachi, which says that our channel checks have not been encouraging. They say that the company's been struggling in terms of pricing wars seen across majority of the players in the RAC space. So while Nirmal Bang is saying this for Johnson Controls, it just shows the pricing wars happening across the board. So, two stocks from mine to watch out for. Most others covered during the course of the show. Of course, we'll show you a complete table of all the hits and misses on the results front so that you know what is the kind of reaction that the stocks might see. I mean, a lot of these stocks, the hit or a miss, and you have a complete snapshot of what some of these stocks could do this morning.
Yeah, absolutely. But let's begin with our special guest this morning. We're speaking with Brett Knobloch. He's CFA research analyst at Cantor Fitzgerald. They came out with a report on Adani Enterprises, and it's an interesting one. They've initiated coverage, and the rating is overweight, with a 4,368 12-month target price. We're trying to understand the rationale behind the report and some of the points mentioned there. Very good morning, Brett. Great to speak with you here on NDTV Profit. Glad to have you here with us.
Thank you for having me.
All right, let's begin with how you've titled your report. India's path to self-reliance runs through Adani. And through that 47-page report, you have time and again sort of connected where India is right now and where the Adani Group is positioned in terms of its infrastructure play and India's policy initiative to be more self-reliant. Can you just give us an overview of why you initiated coverage and why you see this connection?
Yeah, I think, we initiated coverage for a lot of reasons. First, just from Cantor's point of view, we think India is a big growth opportunity for us. This might just be one name, but I think it's a start of a much larger global push for our franchise, but especially in India. And with the Adani Group and its helping India on its path to self-reliance, I think if you just look at everything that they have built over the last several decades and have spun out and emerged from gas, ports, Adani Wilmar and food, utility, energies, you name it, it's giving India, the infrastructure that they need so that they can be self-reliant and not so reliant on other countries, whether it be China or the US or other big trading partners. So when we look at what initiatives are currently going on in India that is going to benefit Adani Group, we kind of first just looked at the segments that Adani is operating, then looked at the policies that are being implemented, like just on the roads, and look at how much roads that they're building. Just at Adani alone is looking to build over 6,000 kilometers of roads over the next several years. And with roads come more transportation. Same thing with airports, right? Adani is now the largest operator of airports in India, and the airline industry is relatively unpenetrated relative to more developed economies. So you increase air traffic, It all helps kind of drive economic growth. And if you look at just the portfolio of companies within Adani Enterprises, they're going to benefit from a larger India. And I don't think there's any other way to look at it besides that.
Yeah. Brett, can you hear me? Yeah.
Yes.
All right. So you also go on to say that, in a sense, because it is a holding company, Adani Enterprises holds many of the businesses that the group is doing, investors are getting at least 5 to 6 companies free, in a sense. Does that explain why your target price is at 4,368? Can you break that down for us?
Yeah. So I guess, as you know, Adani Enterprises is effectively a publicly traded incubator. Part of the strategy is to build and then demerge businesses, which, we believe makes sense to now value those businesses as a standalone entity. Now, Adani does a good job disclosing revenue, profitability, debt, and assets for each segment, which is helpful for us to, I guess, given the valuation framework that we use. Now, whether it's data centers, airports, road construction, renewable energy, or mining, there are many publicly traded businesses out there that we can use to help kind of determine the appropriate multiple. So we look at what those comps are doing from a growth or profitability standpoint, compare that to Adani's business. And in many instances, Adani's business is growing faster, just as profitable. So, we just think it deserves a trade at a premium multiple to those comps that we came across. Now, we think our valuation is really driven by 3 segments. That's airports, roads, and ports. If we look at the airports business, right, there's a handful of publicly traded airport operators. The 2 fastest growing are airports of Thailand and Auckland International Airports. They trade on about 20 times 2025 EBITDA. You compare them to Adani's airport segment, we think Adani has the advantage there just because it's the largest airport operator in India, which is the most populous country. And if you look at airline penetration rates in their core market, 3 to 4% now, we think they can go to 15 to 20% over the next few decades. So you're going to get growth from that. And on top of that, you have Adani completing their Navi Mumbai airport, which gives them capacity of about 90 million passengers. That's 2 times as big as the largest airport in the US. So we value that on a 30x multiple, which we think is kind of easily justified. And then go to the roads business, right? There's 2 very close comps there in Atlas Arterian Transurban Group. They're trading about 24 times 25 EBITDA, which is fiscal year 26 for Adani. We forecast Adani's group to grow faster and it's just as profitable. So again, we think a premium multiple applied to that segment makes sense at, I believe we're at 25 times for that. And then the last segment is renewable energy. And this one is a mixture of, I would say, relatively more established businesses and some, I don't want to say moonshots, but incubating businesses. So on the more established side, you have your solar manufacturing, your wind manufacturing, and then you'll have electrolyzer manufacturing. And those 3 will be, call it, fully operational within, call it, 24, 36 months. If we're looking at just those 3, we think they can do about $1 billion in EBITDA in 3 to 4 years. And given we have them growing revenue in that segment at upwards of a 65% CAGR over the next 3 years, we think that itself could also be trading at a 20 times multiple, right? So now you have 3 different segments that could be doing $1 billion in EBITDA in 3 years that could be trading on a multiple north of 20 times. That in itself gives you a $60 billion enterprise value right now, where the current enterprise value of Adani is just $40 billion. So you can see how you can get meaningful upside just from those 3 segments. And those 3 segments, when you compare to the total business in their most recent fiscal year, didn't even account for 20% of the total revenue or EBITDA. So that just means you're getting your very high margin mining services business, your coal mining, commercial mining blocks. They have 7 blocks in Australia, the Carmichael mine. And a handful of other, their digital business, their data center business, their Adani Wilmar stake's worth 170 rupees right now. Right. So yeah, we think just those 3 segments give you meaningful upside right now, which implies everything else is kind of free.
Brett, firstly, good evening. Thanks for staying up for us late evening in the US. That's Samina on the side. You believe that airports and energy is the big bet in the Adani enterprise. You've also maintained that in the last 7 years, what the incubator has done is hived off or demerged its businesses for value unlocking. In terms of timelines, when do you think, or what are you expecting or working with in terms of a demerger maybe? Is that the game you're playing? And if yes, what is the time horizon that we're working with, or you're working with rather?
Yeah, I don't think the company has gone out and kind of put anything on paper yet. But if we had to guess what the next business that would be to be demerged, we think it would be the airports business. There's 7 operational right now. The Navi Mumbai Airport is going to be their first phase is going to be completed and call it within a year. We think within 3 years' time that will be completed. It'll be at capacity. It's still going to be growing extremely fast. That's when they'll probably look to think about demerging that airport business. And at that time, it could be doing, as I said, close to, if not more than $1 billion of EBITDA, probably growing high teens-ish, if not more rates. So we think it would probably make sense to look to demerge that business around then. Outside of that, there's a lot of options. At that point, your data center business could be reaching much better scale. We have that by 2030, probably doing close to $600 million in U.S. revenue. The renewable energy side, we think is probably a bit longer term, just because what they're doing there is really trying to build up a huge ecosystem, right? You have renewable energy from wind and solar. They're using that to power the electrolyzers, which they are also manufacturing. They're using that to then make green hydrogen, and then they're using that to convert it into ammonia and urea, building pipelines that connect into ports, and that is a 10-year play. So I don't think we're going to see them look to demerge that business until you probably at least get phase 1 of that green hydrogen plant completed, which is going to be fiscal year 27, but most likely not until probably several years after that. But I guess that was a long answer, but airports is, in our view, the best bet to be demerged first.
Is this the first Indian company you're covering currently? And is this the only Indian company that you're covering?
This is the only one and the first one, and we look to be launching on a lot more.
And what's led to that, Brett? Is it a request from your clients? I mean, what has made you sit up and notice not just India, but Adani as well? I do understand that we are being talked about with the kind of recent gains the markets have seen and policy continuity. There's so many things working in our favor. But what's made you pick Adani? Is it just a proxy play? Is there anything else that is coming in from your, from your clients that's encouraged you to take notice?
It's some client driven. It's some kind of on my own due diligence, and I'm lucky enough to have support from the higher ups, giving me the freedom to go out and launch on what I think is interesting. And we look for, call it, companies where we think there's very attractive risk reward that would appeal to our clients that are relatively undercovered. And when you look at Adani, I think it's safe to say it is extremely undercovered, especially given how big it is. So from being a first company to launch on in India, I think it makes a lot of sense, not just as one company, but it's actually a lot more than one company, given all the different businesses operating within it. So we think it is kind of a perfect first company to launch on as we kind of enter the Indian market.
Yeah, and we look forward to more coverage out there too, Brett. But just one quick follow-up to that. In your note, you mentioned about how India's ambitions for becoming the third largest GDP go through becoming an infrastructure powerhouse. And therefore, in some sense, is this conglomerate, and by virtue of that, Adani Enterprises becomes the entity, the best way to play that infrastructure proxy story? And therefore, part 2 of my question is, would you believe that the story runs much longer than the 2, 3, 4 year target or 1 year target that you may have on Adani Enterprises currently, because infrastructure businesses are such long gestation businesses?
Yeah, I think that's a good way to put it, right? I think you could look at this over a 20-year view if you really wanted to. Right? Obviously, you can identify very notable near-term catalysts where you can kind of recognize or return value to shareholders through these demergers. But there's also a handful of other businesses that they have that won't pay off for maybe another 10 years if you're looking at the green hydrogen business. But that business itself could be doing almost $8 billion a year in EBITDA in 10 years. You put that on a 10x, 10 times multiple, you could see how that would be worth more than 2 times the current value. So what we like is you don't need all these different things to hit. You just need 1 or 2 of these to hit. So it comes with a good diversification from that. And if you look at just India as a whole, it's grown at a CAGR 2x that of the US over the last 20 years. They just came out expecting 7% growth this year. The biggest gap right now between India and China is the GDP per capita, where they're 5-6x less than. And I think the investments that the country is making right now is going to be very fruitful in closing that gap. And with that comes a lot more discretionary income for consumers. And Adani's getting more into consumer businesses. They're going to have more money to spend traveling, which benefits their airports. They're going to need more energy, which benefits their commodity trading, their mining, their renewable energy business. So it seems like everything that India is doing to become a much larger economy has some indirect benefit to where Adani's businesses are currently operating.
Yeah, or just that the promoters thought it the right way to go about and build the business around this India growth story. Just one quick follow-up, Brett. Did I hear you say that your current valuation that you ascribe to enterprises captures only 20% of the revenue or / EBITDA that comes in from the 3 businesses, and everything else is over and above that? So I'm just trying to understand, is that what you said? And if so, what's the optionality value that you are attaching to some of the others? If not formally, then informally.
Yeah, so our valuation is based on call it a calendar year 2025 or their fiscal year 2026. So if you look at last year to going from last year to then, the business is going to be a bit different, right? Their largest business last year was integrated resource management, which was over 70% of gross revenue. And that was just because it was a very high volume year and coal prices were very high, and it's very correlated to coal prices. Coal prices have come down a lot year over year. So you've seen that business come down from 70 to 50%, give or take, of it. And we expect that's going to continue to decline as some of your newer, higher growth segments take more, mix of total gross revenue. So I guess my statement's a bit misleading given how high IRM was last year. And our 26 numbers call for, very high growth of these 3 segments. But the mix of those businesses, if we look out in 3-4 years, is still probably going to be less than, I would say maybe 40% of revenue. That's just because IRM is very big, but we value IRM and the mining business on 10 times EBITDA, which is in line with some other where the coal miners currently trade. So we don't use any, I think, crazy multiples for those segments. But our valuation is really driven by airports, roads, and the renewable energy.
Brett, one quick question, in fact, last question from me. You indicated that you've started coverage and, of course, Adani Enterprises proxy to the India growth story. Are you also studying the other Adani Group stocks at this stage, or have you studied those stocks and decided to pick an Adani Enterprise?
So we've only launched on Adani Enterprises. I think with that comes some, you kind of need to look at the other businesses, right, to know the full Adani story. You need to know that they've demerged 3 in 2015, 2 in 2018. Adani more recently spun out. So I think you need to be a bit more cognizant of the entire kind of portfolio of companies or Adani named companies. But we really just started with Adani Enterprises. We liked the publicly traded incubator approach that it is. So I would say we haven't looked extremely deeply into all of the other Adani named companies, but again, potentially something in the future.
Okay, so something in the future, perhaps. Just one last point, Brett, is you've spoken in detail about what you find exciting about Adani Enterprises and the group, but in your note, you also talk about risks and downside risks, as we do when we analyze companies. What do you think the key risks are? And if I come to your number 1 risk in your list, which is the political environment, the relationship with Government of India, as you've named it. Do you think that that risk is now minimized considering the expectations being projected for the next general election?
I do. Obviously, elections are always difficult to call. You never really know what's going to happen, but I think you can draw some correlation to I don't want to say the rise of India, but I'm sorry, the rise of Adani and Prime Minister Modi's ascension to power. But they've clearly benefited each other, and India has benefited as well. So it's more of an unknown than I would say a risk if there is a change in leadership. But I would say with the way things are looking at right now, that risk does look a bit minimized.
All right. Thank you for that, Brett. Fantastic conversation there. Cantor Fitzgerald has begun its India coverage and its Indian company coverage with Adani Enterprises. They seem very, very bullish on the company and see it in a sense as a proxy for the India story. So good conversation, Brett. Hope to have you back when your next report is out. Absolutely. Niraj, what I found interesting is the push on airports and the aviation story, and especially the Navi Mumbai airport. The point that Brett made and the report makes that this is going to have the largest passenger load in the world compared to any airport in the United States or anywhere else. Are we prepared for that? Are those numbers going to come in? Is the question.
No, it's a brilliant story in the making, right? The Indian airport hub. I mean, do we become a transit hub at some point of time? And do we have the airports to be able to handle that? And could this, actually, the Bombay airport, the Bangalore airport are fascinating airports as they are currently.
Yeah, they're fab.
Yeah, but and Delhi for that matter. So yes, but it's interesting. The other interesting piece, Tamanna, that I thought from an enterprise's perspective, that he's saying that there is whatever he said, 40 billion, 60 billion, so about a 50% upside on the valuation front, which is accounted only by 20% of the businesses. The rest come, in his words, like he mentioned this, on for free, and because it's a 10-year story. Now, if the analysis is on the button entirely, imagine the kind of runway that some of these businesses, like Adani Enterprises, have over the course of the decade. I think that's the key. That's what stood out for me, at least.
Yeah.
It's such a
it's a bargain deal right now because you're paying for one company and you're getting at least 5 to 6 companies. Perhaps that could be demerged in the future as quote unquote free.
Yeah, and this goes in. So we should have asked him maybe just before we take that break. But when I spoke to Rajiv Jain of GQG last year, when he bought into these stocks and then the other infra names, he believes that infrastructure businesses in India are not valued the way they should, and the valuation metrics and the valuation methodology will change over time, and you will see great value there. So Rajiv Jain is laughing his way to the bank. Well, if the stock touches this, then Cantor Fitzgerald's clients also will be very, very happy.
Okay. On that note, standard disclaimers, of course,
yes,
that you're seeing this entire program on NDTV, which is part of the Adani Group. It's a subsidiary of AMG Media Networks. Time for a very quick break, but as the countdown to budget begins, we get your top corporate voices and what they expect of the interim budget. Listen in to what TV Narendran of Tata Steel and Ajoy Chaudhary of REC says.
Focus on infrastructure. I think that's very important for us. Helps steel demand, also helps us reducing the cost of doing business. And of course, if the imports from China continues to grow, we expect some support from the government as was provided in 2015.
Infrastructure is on the priority of this government. So infrastructure, more and more emphasis will be given. Last year, 10 lakh crores was allocated for infrastructure. This year, we hope that similar amount will come to infrastructure projects.
Welcome back. Let's take a quick look at the headlines at this hour. The IMF upgrades India's GDP outlook to 6.7% on the back of resilient domestic demand. Also believes growth in China will pick up. US markets trade mixed amidst caution ahead of the Fed outcome. Asian markets follow suit. Early risers open mixed as China and Australia await key economic data. Meanwhile, Tata Motors market cap races past Maruti, clocks 3.12 trillion rupees, becoming the most valuable auto company. And keeping it with the Tatas, TCS signs with a new 15-year pact with Aviva PLC to service its 5.5 million customers. The deal is expected to be worth over $1 billion. Swiggy's FY23 losses increased to over 4,000 crore rupees despite a 45% surge in revenue. So those are some of the top headlines at this hour. But let's go to all the big headlines and stories from the F&O segment. It's a big day, Agam, today with Bank Nifty expiry.
Yeah, it certainly is. And a day before the vote on account, which means that there could in fact be increased volatility and expanded premiums. But let's start by taking a look at what's happening yesterday. And well, we did see a 1% cut as far as the Nifty is concerned, but a lot of positions being taken off the table in the run-up to the budget. So that was indicated by a decline of nearly 9% in open interest in the Nifty futures. The Bank Nifty futures, again, really didn't see too much action. In fact, a marginal decline as far as your OI is concerned, and, well, marginally in the red. But when it comes to the Nifty options space, how did things pan out? Well, a little more writing, around 21,700, and as far as puts go. And, of course, a lot more writing, around 21,600, considering the Nifty came off to a certain extent yesterday. And, well, it was 21,600 where we saw a lot more activity around in terms of calls as well as puts. Where does that leave us in terms of the range that we are expecting? Remember that day before, max OI in calls was at around 22,000 mark, and that has shifted now to 21,700. It does seem like at the moment traders are betting against the Nifty moving significantly higher from current levels, which is indicated by a substantial amount of call writing and not as much writing in puts. In fact, the 21,500 put hardly has as much open interest when compared to that in calls. Let's take a look at how things are shaping up as far as the Bank Nifty is concerned, because that's where you do have your weekly options expiry coming on, and a lot of activity around the 45,500 mark, which also is become a little bit of a pivot of late for the Bank Nifty and the index. Moving on to stocks, we've seen a bout of longs building in Concord and Z Entertainment, Bajaj Finance reacting to earnings, so seeing shots there. In terms of stocks which are seeing unwinding in trade, let's pull that list up as well. We are looking at short covering for JK Cement and Syngene International, Coforge along with GAIL and MCX looking at longs and winding. But I reckon that all eyes will be on the benchmarks. And speaking of the benchmarks, let's get in a voice to see what they're making of this market. Well, we have Ajit Rambia of Ajira Ventures joining us on the show right now. Ajit, good morning. Thanks for joining in. Let's start by taking your view on what you think and how you think the Nifty and the Bank Nifty are going to pan out, not just until tomorrow, but also beyond the vote on account. How are you seeing things? Okay, I believe we do have a technical glitch there. I believe we have a problem with Ajit's audio, and we'll get you back. But as I was suggesting, that the fact that we have seen 45,500 as that little bit of a pivot coming through as far as the Bank Nifty is concerned, and that is again going to be a crucial level to watch out for today. And I reckon that we have Ajit back with us, so perhaps he can take us through his views on the Nifty and the Bank Nifty. Ajit?
Yeah, sorry for the audio glitch. Good morning, Agam. Thanks for having me on the show. So as we gear up for what lies ahead, my view is that we might experience a sideways movement for the short term. It's like the markets are in a holding pattern, waiting for the cues from the upcoming interim budget announcement and the Fed meeting outcome tonight. So we anticipate a range-bound scenario with occasional movements influenced by these key events. It's like the market is gearing up for a performance where the main act is yet to begin. So we might see some lateral moves than a clear trend. So to start with, Nifty shows a strong support at 21,450 levels and a resistance at around 21,750 levels. And Bank Nifty is showing a clear support at 45,200 levels, and the resistance is placed at around 45,700. We have the Bank Nifty expiry, weekly expiry today, so that might show some trend. So I would also recommend to buy on dips at these levels for a long-term position.
Okay, Ajit, so let's move on and talk about stocks. And I believe Syngene International is right at the top of your ideas. Can you take us through the strategy that you're implementing here?
Yeah, so we are bullish on this counter. It has made a triple bottom with strong volumes. So we can initiate a bull put call strategy, spread strategy, where we buy a February future at 720 rupees. We hedge it by buying a 680 put at 9.85 rupees. 680 is the support from where it has made the triple bottom. And to cover the cost of the put, we sell a OTM call of 760 at 12 rupees 40 paisa, which is our target. So here our support is 680, current price is 720, and target is 760.
Okay, if you guys see the payoff structure of the strategy that Ajit has just mentioned, it doesn't look very different from what you would have in terms of a bull spread. But the only difference, of course, in this case is that Ajit in this case is buying a futures, going short on a call, and also going long on a put. Ajit, moving on, if you can also give us your view on the other stock idea that you have.
Keeping in mind the overall trend of the market, we feel Vodafone Idea is best suited counter to trade in such sideways market. Vodafone Idea has been in and around rupees 15 for quite some time now. So adding to this, we can find some attractive premiums to play with. So we initiate a iron condor strategy where we sell a 15 rupees call and put both. 15 rupees call is placed at 85 paise and 15 rupees put is placed at 1 rupee 30 paise. We sell both this call and put, and we hedge it with buying a 12 rupees put at 15 paise and 18 rupees call at 30 paise. So the net credit for this strategy goes around 1 rupee 70 paise. So we are safe. So we earn in between that.
Okay. All right. So, well, of course, Ajit in this case is taking advantage of the higher volatility that Vodafone Idea has already seen. But remember that the earnings are now out of the picture, and there's an expectation that there could be some amount of consolidation in Vodafone Idea, which is why Ajit is going ahead and, in fact, going ahead and selling a straddle that is nearly at the money, and to counter and to make sure that the losses are not unlimited, he's in fact going ahead and buying a call and a put, an out of the money call and out of the money put as wings, so as to limit your losses just in case if things do go awry. Well, that's your view as far as the Vodafone Idea is concerned. Ajit, on that note, would take a moment to thank you for joining us and taking us through your views on the markets, as well as giving us a handful of trading ideas. And with that, it's back to you, Tamanna.
Well, thank you for that, Agam. It's going to be an interesting day ahead of a huge event coming up tomorrow, and we'll wait to see how that pans out. Meanwhile, the focus is back on results, and Dr. Reddy's came out with their Q3 numbers yesterday. We spoke to the management on the company's growth targets in the US and the way ahead for the domestic business as well. Listen in.
We had said that, we would target a certain high single-digit growth in terms of our business. And we are continuing to launch several products in the US. Our expectation is to launch about 25 products every year in the US. We will continue to work on them, and they will obviously be driving the growth other than the growth of our base portfolio, which is where we have been also gaining the market share. The three levers that we are adding to the India business. One is how do we get access to innovative assets, whether they are NCEs or NBEs or CAR-T. The second is in terms of the consumer health, both OTC as well as Nutra. And third is the area of digital. In that, two experiments are already in the market. One is a D2C platform for diabetic patients, and the second one is digital therapeutics and Neribio, which has started to receive traction. Should there be any inorganic opportunities that come our way and make strategic sense, makes a strategic fit for us, we will continue to look for those opportunities. Otherwise, in the coming quarters, you will see India getting back into the double-digit growth.
Yeah. So Dr. Reddy's again seems to have done well this quarter on the basis of lowering of input costs. But let's just take you through what some of the notes are saying on Dr. Reddy's and glean how it will trade today. So Citi maintains a sell target of 5,290 on the counter. They say that Rev Limit's contribution is higher than expectations in FY24-26E. Remember that particular drug is one that is going to phase out in terms of there is a shelf life to how long there will be a few companies, a few pharma companies that will have the advantage of a monopoly on that particular drug. So their contribution being higher might be seen as a bit of a negative. Margins in core generic business will be trending downwards, says Citi, and they expect calendar year 26 to see a $10 million plus product launch over between 25 and 27 estimates. Now, the first major biosimilar approval is also expected in calendar year 27. Meanwhile, IIFL on Dr. Reddy's has maintained to reduce their target is 5,480, and they say it should trade at lower valuation multiples compared to peers. They see a sustained underperformance in India, and that is a point across brokerage notes that the India business has grown just about 5%. The profit pool is coming in from the US, and this Rev Limit, the growth is only 7% despite pricing respite. So Rev Limit is still about 65% of the FY24 EBITDA, and the concentration and dependence on that one product is a bit of a problem. Systematics on Dr. Reddy's has maintained a hold. Their target is 5,725. And they say it will deliver about 7% revenue and 6% EBITDA over FY23 to 26. The North American revenue, which has been a big bulk of it, will be flattish in decline over the near medium term. So a clutch of reports there, not necessarily all of them very positive on a Dr. Reddy. All right. Yes.
No, it's just interesting, and which is what I thought we should take to Shrikant Chauhan and try and understand what the charts look like. So that's the Dr. Reddy's conversation. Shrikant, how closely are you looking at pharmaceuticals currently? I want to start off, good morning and thanks for joining in, of course. Start off with maybe the index and pharma index, and then Dr. Reddy's. There is a Piramal Pharma which might react today to a very strong set of numbers as well. Any thoughts on this space and Dr. Reddy's in particular?
Good morning, Niraj. Good morning, everyone.
Thank you.
I think, all these pharma stocks are really doing well, and they are participating whenever there is a upward activity in the market. But otherwise also, if we are going to see some sideways sort of activity or maybe some cautious sort of activity in the near future ahead of the election, or maybe ahead of the this particular interest rate cut from the Fed and all this commentary, we are going to see some cautious sort of activity in the market, and in that again we are going to see a specific buying interest in pharma companies. But for Dr. Reddy, I think the stock is clearly trending upward. It is very, very gradual. It is finding a lot of resistance close to 5950, 5900 levels. But the way the stock has spent time between this particular 5900 and 5500 levels for almost last 4-5 months, I am of the view that it is on the verge of crossing its upward barrier, which is around 5950, and the next level to watch out for would be then 6300. So the stock is showing a lot of strain. The strategy should be to buy if there is a medium to long-term view. With a very short-term view, because it is very close to the breakout level, it is better to stay away from taking any positions right now. If it corrects back to the levels of 5900, certainly we should look for adding with a stop loss at 5800 on the downside. But we also like Natco Pharma, which is also showing a lot of strain. There also we are seeing upward activity. And furthermore, upside close to 950, 960 is more likely. It's a buy between this 890, 880 area with a stop loss at 850 on the downside.
Shrikant, morning. Tamanna here. And a good view on Dr. Reddy's. But tell me what you are thinking about the Bank Nifty and the Nifty today. You saw quite a bit of pressure coming in right before close yesterday. Are you going to see that sort of volatility? You're seeing range-bound kind of trade today?
Yeah, most of the time it happens, because whenever we face any major event, the market turns sideways and in a and turns volatile in a narrow trading range. So ahead of the interim budget, ahead of the Fed's outcome, we are expecting market to remain in a range of 21,600 on the high side and 21,400 on the downside. But at the same time, because the trend is range bound, we should look for adding position if we see the market is dropping to 21,400 levels with a stop loss at 21,300 on the downside. And for the Bank Nifty, it was a little bit better than the broader market yesterday. So there also 45,200, 45,000 is the area where we should look for adding some contra bids with a stop loss below 45,000. Again, we can expect 45,500 to 700 on the high side. So the strategy should be to buy on dips if there is any correction.
Right, buy on dips. Of course, last week this market was looking like a sell on rally. Mayuresh Joshi, though, head research of Mark Smith India, now joins in. Mayuresh, hi. Thanks for joining us. Mayuresh, big events lined up. I'm assuming tactically this is going to be a sideways market, at least today and up until half of tomorrow. But are you riding high on this budget, or is it just going to be a vote of account and we will move on and focus on other market dynamics?
Morning, Samina. No, so obviously I think the markets will probably see what comes through. It's obviously a vote on account. So to that extent, no significant announcements per se expected. The markets obviously expect a lot more that probably comes through. I think whatever will come through in the main budget in June, July. But on this vote of account, key strategic foresights that the government is expected to give when it comes to capex spending, some kind of a ballpark figure in terms of capital expenditure in terms of certain key areas, and what happens, if any, in terms of the salaried class as well, because the salaried class is probably expecting something to come from this vote on account as well. So not expecting any fireworks, frankly, tomorrow. I think it's an event which will pass through and the markets will then focus back on earnings and global events.
Does that then mean, Mayuresh, you'll be focusing on the FOMC, or do you think a lot of that is already priced in? Because what we've also seen in the last couple of weeks is foreign investors have sold the maximum in India as compared to other Asian markets in the month of January. And if this is a market that's going to be held on by DIIs, and FOMC also in that sense becomes a non-event, you think?
Sort of, because I think it's penciling in to a large extent on what the Fed is probably expected to do. So to that extent, I think the markets will pencil that in as well and factor that in as well. So again, I think both these events will pass through as we speak in a couple of days' time. And the markets will then revert back to the same old boring elements that we probably look at, how earnings are expected to play out and what happens in terms of both the geopolitical sense and the geo-economic sense as well, as far as the inflationary trends and data points are concerned.
Yeah, you know, Mayuresh, you're sounding like us in the newsroom who are waiting for this very busy week to end and wondering what happens next. But stay on, Srikanth and Mayuresh. I'm going across to my colleague Tushar very quickly for an important, news piece on TCS. TCS has signed a new 15-year deal with Aviva PLC to service its 5.5 million customers. The deal could be worth over $1 billion. Tushar is joining us with key details.
Thank you so much, Tamanna, and good morning to all of you. So essentially, if you look at the first key details of the deal, is TCS has renewed the contract with Aviva for 15 years. That's building on the 20-year alliance that the companies have had in the past. 5.5 million customers will be serviced on a new banks platform, that is TCS's BFSI, proprietary BFSI software. It will be managed by Diligenta, that is TCS's UK-based subsidiary. Now, coming to the financial details of the transaction, what our conversation... So, while TCS has not said anything about, it has refused to divulge any details about the financial aspect, analysts told us that this particular deal can bring in $100 million for TCS on an annual basis. So over a 15-year period, that translates to about $1.5 billion at least, as what the sense we're getting right now. The Mint newspaper reported that this could be the biggest deal for TCS, outsourcing deal for TCS at $2.5 billion. That's building on the previous deal that was at $2.25 billion, again on a servicing a similar quantum of clients. Now, what does that mean for TCS's revenue? given the slowdown we are seeing so far. So TCS in FY23 had revenues of $27.92 billion. In the 9 months to December 31st, it had $21.71 billion. So this long-term deal, while the accruals are small as compared to discretionary deals where there are snap returns, this will still be an added benefit for TCS in the long term. So the gap is very small. TCS would like to better FY23, and hopefully this Aviva deal will help in bridging over the FY23 numbers.
Right. So TCS, one to watch out for today, and a pretty significant deal news there coming in. We'll take a very short break, though. We are just minutes away from your pre-open. A quick look at the implied open before we go into the break. It's a muted start by all accounts, maybe a bit of sitting on the fence for investors ahead of two big events. And yes, that's what the Nifty implied open also is indicating at this point. Quick break, but we'll be right back. Stay tuned. All right, a day to go ahead of the big event, two big events actually. It's a double whammy or a double bonanza. We'll know at the end of the day tomorrow. But the FOMC meet outcome will be out tomorrow morning, India time. We'll know at least by then. And of course, you have the vote on account, which is an interim budget technically, but what we've seen in 2019 tells us very clearly that it would be foolhardy to underestimate what could be said in terms of announcement and policy direction. Just about 8 seconds out from pre-open at this point. So we'll also take a look at how markets are responding this morning, wait for those rates to settle before we move ahead. The implied open is suggesting sort of range-bound kind of day. The first cut should be sort of discounted because we'll wait and see how those rates really settle in. Meanwhile, Mayuresh, let me come back to you. You know, the big themes ahead of the budget being talked about are very similar to the kind of run-up that we've seen over the last year specifically, and a little longer than that. So if you're talking about infra, energy, rail, all of these stocks and all of these sectors have really run up. Are you seeing more upside depending on the budget announcement? What are the key sort of factors and keywords that you'd be looking out for?
So two aspects here, Tamanna. One, obviously the expectations in terms of allocation increases that will happen in terms of the capital account, specifically in terms of areas like infrastructure and manufacturing. I think a large part of the market is of the belief that there will be a 10 to 15% increased allocation happening towards these sectors as well. So last budget, 10 lakh crores, expecting around 11.5, 12 lakh crores if that probably plays out. So with this increased allocation, obviously the expectations in terms of more orders flowing in different areas and subsects of all these segments put together, whether it's roads, highways, port development, rural housing, everything will probably come into play. Therefore, a lot of sectors which are associated with all these aspects, as you rightly pointed out. So a lot of capital good manufacturing companies, you're probably looking at a lot of construction equipment companies. You're looking at cement plays as an indirect proxy to all these elements that will take place. So I think that is the core point that the markets are probably looking at. And what the government is probably also hinting at is with such huge capex that comes in from the government side, at some point of time in the next couple of quarters, or the next 2 to 3 quarters, private capex will also start flowing in. And to that extent, I think the entire manufacturing wheel starts moving along very, very nicely. So I think a large part of the market announcement is of the belief in these core sectors. A large part of allocation will probably take place.
Trade is all over the place. I don't think it's going to play out as badly as it's looking. 21,100 on the Nifty 15 pre-open trade. So let's ignore that. That should settle in a few minutes. But important stocks to track will be an L&T, a Dr. Reddy's, a Voltas, potentially Piramal Pharma, SRF. Some of these companies have reported numbers, so you will see a sharp reaction one way or the other. Piramal Pharma indicating to a 5% gap up. SRF on back of weak numbers, 2.5% gap down. VIP Industries, L&T, 5% cut there. I don't think that's how it's going to play out, but if that's how it is going to be viewed, the counter will be getting trashed on back of a little bit of concerns on their margins for the quarter. Revenues have grown, order book is looking good, but margins is what's taken a hit. Shrikant, pre-open, like I said, is all over the place. A quick word from you on L&T. Pre-open is showing a 5% gap down. I do expect it to see a gap down opening. May not be to the extent of 5%. How would you trade L&T? Would you consider initiating a short trade on the counter? Shrikant, you're on mute. We can't hear you. We can't hear you, Shrikant.
Yes. See, like the stock was just going up and up since last almost few weeks and months, but now it is very close to its crucial resistance level of 3,700. I'm not of the view to go short on the stock, but yes, there might be like some correction from here, maybe 2%, 3%, which is not that significant because the risk reward ratio is not at all favorable. But in case if it falls to the levels of, let's say, 3,500 or 3,450, then there we should look for taking positions because the broader trend of the stock is very strong. The only reason it is finding resistance is because of its overall expensive valuations, and that is why at every resistance we are seeing some correction. But otherwise, it's a buy on dips.
It's a buy on dips. That's the word coming in on L&T. But let's move on, Shrikant, and stay with us. We'll come right back to you and Mayuresh and Shrikant and talk to you about the markets. But we are bringing to you a special. Guess which is the world's largest wealth fund and how much profit they've made in 2023, and more importantly, what's their India portfolio. Joining me now is Muralidharan Swaminathan with all the details from the latest portfolio of the world's largest wealth fund. Murali, it's over to you.
Thank you. See, this is a very interesting analysis of the world's largest fund. Let me not hold back. It's Norway's sovereign fund, which is the world's largest wealth fund. And they manage, for starters, they manage the wealth of the Norway governments. To go back in history, they had sometime in 1960s, they discovered oil, and the Norwegian government would transfer all the surplus to this fund. And later it turned out to be a pension fund. Now it's so huge that they are investing in some 8,500 odd stocks across 70 countries, and their total value of holding is roughly $1,500 billion. Okay, now the India part. The India part, if you see from the overall portfolio, is a very minuscule 1.5%, which comes to roughly about $24 billion. Now, this $24 billion is big for us, for the Indian audience. Now, that is one part of the story. The second part of the story is that the market value of the India portfolio has grown by 40%. I'm only talking about the market value.
Invested value was 24 billion.
Invested value as of December 2023. Was 24 billion.
It's about 36 billion of market value now.
No, it was $17 billion approximately the previous year. It has grown to $24 billion, to clarify the point. So the value is surged. We don't know how much additional money they have put in. The reason why I can't find that now, we will. You can go and read on the website later. We'll get a detailed analysis. Now the interesting point is there are 460 stocks that they have invested in India, which means that it would look like a mini small cap portfolio, mini mid cap portfolio, mini large cap portfolio. So there are 3 different small cases that you can find within that portfolio if you segregate them. Now the interesting thing is they have not bet big on tech in India, but they are betting big on
the
tech, the big tech across the globe. In fact, to go back to, I'm moving back and forth, to go back to their world scenario, they made a profit of almost $230 billion in 2023, 50% of which came from the big tech, the Microsoft, NVIDIA. They bet big on AI. 2023, they simply went big on tech. 15% of their portfolio, which is roughly about $245 billion, is invested in tech companies. And the top tech companies are the Microsofts, the Alphabets, the NVIDIA, the Amazon, you name it, they are there, the top 10 are there. That is point number 1. Now coming back to India, you will find that they are not betting big on tech. Their bets are small bets across the board. Let me read some of them. First, I'll take
and this is just an equity fund, right, Murli?
No, it is an equity fund.
And debt?
Usually 80% of it is equity. They invest in fixed income too, because they are a pension fund. But they are heavy on equities, and they are long term. Long term, when we say they're long term in the sense of 10, 15, 20 years.
And market cap agnostic?
Absolutely. Okay. No, they just go by the company. They don't go by the size.
I think what's interesting to understand is what are they betting on in India?
Yeah, okay, let me come. You were waiting for that one. Their top 5 bets are Reliance Industries, roughly $1.8 billion, HDFC Bank, about $1.5 billion, followed by ICICI Bank, Infosys, Axis Bank. See, you can see it on your screen. And these are the top 5 bets. Top 5 bets. Once you go down the ladder, you will find that a large number of small companies. They have also invested in 3 of the Adani Group companies, but that's only $130 million or somewhere around that figure. Let me also take a look at some of them. Tata Motors is one of the big bets that they have, which is number 14th position in the list, and they've invested about $26 million. But the point here is that when they invest a small amount, small caps and mid caps, they surge. Like they go through the roof. So my assessment is that their maximum gain must have come from small and mid cap stocks, not so much with their big hold, because Reliance and HDFC Bank were underperformers.
So your broader markets have done 48% returns, right? So while the percentage may be small, the simple volume and value term, the movement is so much bigger.
Huge, humongous. So the point here is that that brings a lot of stability to the Indian market when you see such funds investing, which is why we are playing this out. Now, there are interesting bets I would like to read. They've invested in Havells, Bajaj Auto, of course, is there. Then they have smaller companies. If I go, InfoEdge, Titan, of course, is their favorite stock. then Supreme Industries, Divi's Laboratories, Cholamandam, Power Grid, Pidilite, Ashok Leyland, you name it, the list is very, Kajaria Ceramics, Zomato also they have picked up in their list, HDFC Life Insurance, Dr. Reddy's, JSW Steel, the list is pretty long. There are also some smaller companies you will be interesting to know, some 361 WAM Limited.
Yeah. Okay.
Okay, that's a very small, I think it's a new addition in this list. Vedant Fashions.
361 is IFL's mutual fund.
IFL's new mutual fund.
So it's the story we've talked about, capital
and
markets.
one of their favorites, though of course the size is not very big, Syngene. Syngene is there in their list. Then you can see Polycab, which has been running a lot. Polycab is also there in that list. Okay. RR Cable. Then, of course, Adani Ports is there, Indian Oil Corporation, TVS. The list is very, very long. So
except tech, they own everything.
No, they are not heavy on tech. You know, say as far as India is concerned, they have a mix of small tech players, mid caps, small caps, and they are not betting big on one or two companies. 460 companies across the board. A very interesting thing. But for more details, do log into our site. We will be able to.
Absolutely. And the big takeaway, like you said, Murli, is that the India story sort of gets another thumbs up with this kind of investment, even in smaller companies, not just the big boys. All right, just a couple of minutes left to open. So let's focus on what your bet should be today, what your call should be today. I'm going quickly across to Shrikant Chauhan. Shrikant, your top calls for the day.
Yeah, I think, see, the markets are opening nearly, 30-40 points lower as compared to its previous closing. And yesterday we saw some profit taking in Reliance Industries, but at the same time, the short-term as well as medium-term, long-term trade of the stock is very strong. So in case if we see the stock is opening somewhere close to this 2800 levels, then there we should look for adding positions with a stop loss at 2770 on the downside. Again, I'm expecting a rebound in the stock up to 2860 or 2870 on the higher side. The other stock on which we are bearish in terms of like with a very short-term view, that is Bajaj Finance. So with a very short-term view, the stock can again fall to the levels of 6500 or 6550. So it's a short at current levels with a stop loss at 6950.
Yeah. Just look at L&T pre-open, and of course we'll have the opening rates in a couple of minutes, but that stock down 3% in pre-open itself. Mayuresh, very quickly, views on L&T and the infra play, anything that you like that is on your list?
So it's a hold. Obviously, I think the guidance that they've given Tamanna is very encouraging, and you should understand, and rather, I think all of us should understand that's the bearment that we are talking about. Obviously, expectations, a slight amount of mismatch for the opening that we are seeing, but the expectations in terms of the order execution, the order book per se, expectations of margins sustaining and revenues exceeding the upper end of the guidance. I think those are positives over a longer period of time. So anybody holding, definitely hold on. We have a stock within the logistics space, which is definitely on our watch list, Gateway Distriparks. I think a lot of moving parts here. One, I think the dedicated Western Freight Corridor, as it starts completing the entire section over the next couple of quarters, I think a huge amount of traction can be seen in volumes, specifically in terms of rail freight volumes that will go through. Own assets are quite significant. They own CFS, ICDs on the west and the east coast as well. And therefore, revenue and EPS dynamics sound very, very promising. So hold on L&T, something like a Gateway Distriparks on your watch list.
Shrikant, quickly, view on L&T?
Yeah, L&T, I think, as I mentioned, it is like buy on dips. In case if it falls to the levels of the current levels, 3500 or 3550, we should look for adding some positions with again target of 3750, 3800 on the high side.
Yeah, so you're veering towards your 3500 level, already below your 3550, so DRL might be a quick one. Just another one on Dr. Reddy's. I know you talked about Dr. Reddy's and NATCO, but if you just pull up what the pre-open rate is, would you change your view there? Anything interesting worth accumulating at 5825, Shrikant?
See, like, as I mentioned, the stock is very close to the breakout level, so it is always better to buy on dips. So close to this 5800 levels, we should look for wait for some time because it is opening to the support levels only. So after opening, if there is any reversal pattern, certainly we should look for adding positions. With a medium to long term view, we are specifically bullish on the stock based on its technical formation. But for the time being, I mean to say with a very short term view, it is better to be wait for the reversal formation.
Right, Shrikant, Mayuresh, hang in there. DRL posted numbers that beat street expectations at 28% EBITDA. Despite that, the stock is not seeing a positive opening. It is going to be a sideways move. Don't expect fireworks on the street today. We go into the big budget tomorrow. You've also got FOMC globally. So lots of, it is an event-heavy week, and more importantly, event-heavy 2 days. It's a weak start. We've broken 21,500, which we struggled to close above in yesterday's trade. 37 points off, 0.2% low. Now, this is looking slightly uncomfortable for the street. Remember, the intraday high that was made yesterday in trade went above levels of 21,800. So it's a sharp downtick from where we closed out or saw the high in trade yesterday. Bank Nifty is taking on the chin. Fin Nifty was quite weak with the Bajaj twins getting a whack in trade yesterday. Today, 200 points off on Nifty Bank, and that looks unsettling. Broader markets, interestingly, outperforming the benchmarks. So mid-cap and small-cap index are both trading marginally higher. The Sensex also down about 0.2%. Okay, that's the small-cap index, 0.5% gain. So that's one area in the market that's actually keeping it together. But the Nifty itself is seeing tremendous selling pressure, not looking good at levels of 21,000, sub 21,500. Breadth of the market is biased towards the downside. Quickly take you to the top loser of the day, L&T. Numbers were largely in line. Margins were disappointing. Fourth quarter, remember, which seasonally is a strong quarter, may be quiet this time on back of general elections. But disappointment on the margin front is what's impacting L&T's performance in trade this morning, down 5% in trade. A quick check on how the Bajaj twins are doing this morning. So there's a little bit of recovery that's coming to Bajaj Fin and Bajaj FinServ after that big fall yesterday. Both those counters are settling at the current levels. Like I said, banks are taking it quite badly. Kotak, ICICI Bank and Axis are both weak. Autos that were in a sweet spot yesterday. Tata Motors, remember, overtook Maruti and market cap for the very first time yesterday, is seeing a little bit of weakness. Maruti also looking weak ahead of its earnings later on in the day. So all in all, the sell side looks bad. On the gaining side, we covered that, of course, the Cantor Fiscal report early this morning with the analyst. Adani Enterprise was a big bet. The stocks have been doing quite well. Adani Ports as well, actually. Today participating in the run up 2%. Tata Motors, after a sharp move yesterday, is up another 2% this morning. So Reliance Industries does 1% odd. So despite Tamanna, your Tata Motors, Adani, RIL actually not doing too badly. The index is seeing a sharp cut, and that's probably because of the way L&T is doing this morning.
Yeah, L&T seems to be the culprit of the morning. And like Samina said, the numbers on the face of it aren't too bad. But remember, the expectation is that your capex expenditure by the government will be significantly lower than last year because they have to keep to their fiscal deficit targets. And so if your infra spends from government are lower, does that impact an L&T order book? Perhaps that could be one of the reasons that we're seeing. But let's take a look at the broader end of the market. Yeah, L&T, the big story this morning, down 5% now. But broader end of the market and the stocks on the list that we should look at and how they're performing. I'll start with Cochin Shipyard. We talked about it in your pre-open as well. It was on our watch list for a really solid set of numbers, and that stock up about 5.5–6% in morning trade. Remember, they've had a doubling of profits, almost up 103%, margins up over 6–6.5%. JBM Auto also had a pretty good set of numbers. Let's see what's happening with the stock. Yeah, your stock price is up about 2.5% in open trade. The margins here were not too high, only a 53 bips jump up, but your EBITDA was up 48%. Paras Defense is the other one that I've put on my list. Defense, in any case, is an interesting space to watch ahead of a budget, whether you call it a vote on account or not. But to be honest, nothing is stopping at least this government from pushing that Make in India defense play, and you might see that play out tomorrow as well. So Paras has signed a licensing agreement for transfer of technology. That's important. The TOT is important with instrument research and development established. And this is for remote control border defense systems. Paras Defense, one to watch out on. We're talking about numbers and how the street is responding to them. JP Associates is the other one that we should quickly look at. The numbers weren't great at all, and the stock is taking a beating, down about 4%. Revenues were down nearly 20%. EBITDA down 48.5%. Margins is what you should look at, even though net losses have widened, but margins are also down about 357 bips, about 3.5%. NTPC is the other one. They have a deal going. They've signed an MOU with the Maharashtra government. They will be investing 80,000 crores in the next 5 years. NTPC has been doing well. Power, again, one of your budget stock lists that you should keep. And let's come to M&M Finance. Now, in your list of companies that have seen good numbers relatively, M&M Finance is definitely one of them. That stock up 3.5%, nearly 4% today. SRF, very quickly, numbers weren't great, but the management con call showed some positivity. They expect a better guidance for the rest of 24, the fourth quarter of 24. And Z Entertainment is the other one. Let's see what Z is doing this morning with all that back and forth, SEBI clarifications, etc. That stock now 1% down. So these are some of the news and results-driven counters. But what else is playing out in the markets today, Samina?
Tamanna, it's largely results, right? So you've got, again, reactions across the broader markets, which are results-focused. Policy Bazaar, that is turning out to be a stellar performance this morning. They've managed to reduce their loss on the books significantly. On back of that, Policy Bazaar sees again a very sharp gain, a 10% rally on the stock this morning. You've also got Keynes Technology, that's up 4%. UTI Asset Management, couple of brokerage calls post its earnings. The stock looks good, 4% rally, building on to the rally that we saw in trade yesterday. KEC International, similar reason, the stock trades up on back of numbers. Well, those are a few gainers that we've seen. Avanti Feeds is up 5%. Godfrey Phillips reported earnings yesterday. Numbers weren't too bad, but the reaction yesterday was not as strong as it is this morning. 6.5% up move on Godfrey Phillips is what we are seeing as we speak. India Housing Finance, Mahindra & Mahindra, Global Health are some of the other top gainers. On the sell side, IRP Infra, after gaining very sharply for the last 3 days, is now taking a cut of 4% odd. VIP Industries, a huge disappointment on their earnings. Their profits have been impacted. Margins have eased off quite sharply. On back of that, VIP sees a cut of 4%. SRF should be also seeing a negative reaction. Their numbers were also a huge disappointment. But surprisingly, the stock still does okay in trade. Weak numbers there. There is a rebound expected in terms of performance over the next financial year. But for now, despite weak numbers, SRF sees a positive up move. You've also got a few other names that are worked back. Actually, KPIT, while we had added reported numbers yesterday, we will be connecting with the management, in fact, soon. The stock sees a gain of 1.5% again in today's trade. Maruti will be one to watch out for ahead of their numbers, expected later on in the day, but it is Tata Motors. It's grabbing everyone's attention. Shrikant, and I'll come to you on that one. Tata Motors briefly overtook Maruti in terms of market cap yesterday. Good run on a bad day. Continues to do well in morning trade when the markets generally are feeling a little low, a little down. At these levels, Tata Motors becomes a buy for you. Any significant technical levels have been taken out?
See, again, based on technicals, the stock is showing a lot of strength. It is forming higher top, higher bottom series, not only on short-term charts, but also on the long-term charts. And in fact, after breaking the all-time highest levels at close to what nearly 600 levels, the stock is not like reversing from any important level. So it means that the stock is heading higher and it is heading for the levels of at least 1,000 in next few weeks or months. I'm not saying that it will happen very soon, but it is heading for those levels. And the strategy should be to buy on dips if there is a technical sort of view in the market. Ideal levels are close to what, 850, 855. There we should look for adding positions and with a target of 1,000 plus.
Absolutely. Let's take a look at some of the results impact DRL very quickly. Look at what's happening there. I also want to pull up Sun Pharma. Sun Pharma numbers later on today. So is Maruti. DRL up about 2% on numbers. Not bad at all. Their input costs have gone down. India business is not done too great, but returns from US, etc., have been good. Sun Pharma ahead of numbers also not too badly. Piramal Pharma was another one that we talked about this morning. Let's quickly mark what's happened there. And not bad at all. 4% up right now. Mayuresh, anything you like in the pharma space right now, or would you focus on your, I would say, core industries in the flavor of the season, which is the budget?
No, having said that, I think pharma selectively, Tamanna, also looks attractively placed, but very, very selectively. Obviously, we continue to hold our longs in Sun Pharma in our global portfolios. the broad expectation largely is the kind of specialty pipeline drugs that they probably have in phase 2, phase 3. As these have these estimated time periodicities of fruition coming through over the next few quarters, that can have a significant impact both in terms of revenues and margins, because they will command better margins compared to the rest of the pack. One of the stocks that we probably got on our watch list is Zydus Life. 2-3 things happening here very interesting. One, I think the branded generics portfolio is expected to do well going forward, as well as the expectations in terms of a few key launches and approvals over the next few quarters. Decent balance sheet, expecting reasonable amount of growth, and the kind of EIRs that they have received for their plans would largely suggest that FDA kind of concerns probably do not emanate in a stock like Zydus Life. Any pullbacks on this one can be a good buying opportunity. This stock definitely stays on.
Right. Thanks, Mayuresh. Thank you, Srikanth. Great having both of you in the studio on the show this morning, giving us some perspective on the markets. In the meantime, it's not a great day on the street. One stock I want to pull up, which was on a break out yesterday, was Ganesh Benzoplast. Actually, the Nifty is seeing some recovery in trade. Continues to see a marginal gain this morning. 13% rally yesterday, marginally higher this morning. There's been enough and more news on the counter recently with their, intention to join the LPG business, stake by Malabar Investments, and now some more good news coming their way in terms of an arbitration ruling in their favor. Rishi Ramesh Pilani, CMD of Ganesh Benzoplast, joins in. Hi, Rishi. Catching you sooner than we'd have thought, but again, some good news flowing in for Ganesh Benzoplast. A ruling has been in your favor with regard to infrastructure logistics systems. I believe the matter was in arbitration since 2015. Take us through what the outcome is, what the numbers are, and when will the money hit, get paid out to your group company?
Yeah, good morning. So basically the matter was in arbitration regarding the movement of MEG by our rails in the rail business that we have. And the money, the net amount that we are expected to get is about 19 odd crores. And we expect the money to hit our account soon, probably within the next 3 to 4 months, because the process, what my lawyers explain, is that even if they have to go for an appeal, the amount has to be deposited, which is we can withdraw against the guarantee. So I expect the money to come to us soon, but it's a judicial process, so no timelines can be committed. I can only give my expectations.
Right. So this clearly is a cash flow positive. What is the anticipated use of these funds? Are you going to be investing in the LPG partnership that we spoke about last time? And also a quick update on the preferential issue that has been planned and done.
Funds issue, like I said, the project is approximately around 600 to 700 crores, and the equity component is about 30%. Of which we are approximately 50%. So it's about 100 crores or so, which is already lined up through our internal accruals and through the preferential allotments. Like I said, we want to grow more in the liquid and the cryogenic space. So the funds that we are raising right now, we are dedicating it towards increasing our capacities over the next 3 to 4 years, about 40 to 50%, and hopefully the revenues grow at least double of that. That's the expectation.
Right. Thank you so much, Rishi, for joining us today on that news flow, and we will speak with you soon when your next announcement is up. Ganesh Benzoplast, Rishi Pilani there on the arbitration win that they have had. Quick look at where the markets are and in recovery mode. I just want to pull up a couple of small cap buzzers today. Godfrey Phillips, numbers weren't great yesterday, but that stock up about 11% higher. Are they expecting no additional taxes on cigarettes? I'm not too sure. Brigade doing very well this morning. Cochin Shipyard we spoke about. Keynes Technology also on the back of numbers doing fairly well this morning. On the other hand, a VIP industry is getting hammered down about 4.5% as assigned, and IRB Infra. Looking like a sort of a range-bound and weak morning this far, but we're keeping our eye on the markets and a lot more at this point, and we will stay with you on that. We'll take a very short break at this point.
Right. That, of course, is how the markets are doing. A couple of earnings reactions, what you're seeing. The breadth of the market, remember, is slightly weak, but it is largely L&T that is putting pressure on the index. Around 21,500 is what we have. Well, we've got PVC pipes and plastic products maker Astral that reported a 19% increase in net profit in their quarter. I caught up with Mr. Savlani, who's the CFO of Astral, about the company's outlook, and the current company believes that they will continue to post strong volume growth in the 20s for the next couple of quarters. Values, though, margins, though, have been slightly under pressure. But hear out what Mr. Savlani had to say in that conversation with me.
I think this quarter the volume growth was 15%, and on a 9-month basis the volume growth was 24%. As far as value is concerned, because polymers was falling continuously since last 3 quarters, in spite of that we were able to fetch the 8% value growth in this quarter, and on a 9-month basis roughly about 10% kind of value growth. So overall I think the quarter was fantastic. Against our guidance of 15% originally in the beginning of the year, we revised in between to 20. And today, when we are talking to you, it is 24% on a 9-month basis. But I think we are far ahead of what we have guided to the street.
Indeed. So, Mr. Savlani, let's talk about volumes for a minute before we talk about polymer prices. In terms of volumes, you did say a 9-month, you've clocked in 24% volume growth. This quarter's also been pretty good for the company. In terms of guidance for the next couple of quarters, what can we expect, and where do you expect the year to close out at in terms of volume growth?
So I think year definitely going to close more than 20%. There is no doubt about it. And for the little ahead, I think next year we are expecting, at least on a higher base also, we should close 15% volume.
And what about polymer prices? I mean, a couple of quarters ago as well, polymer was playing spoil sport. Do you feel like now, at least after rugging it out in the last 2 quarters, polymer prices are bottoming out, and from here on, things could start looking up for at least value growth?
Yeah, definitely, because almost you can say after so many, I think, say, quarter, we are seeing the bottom. And it looks that it should be the last leg, because it is very difficult to predict the commodity. But it looks like that now we are on the last journey of the bottoming out. Maybe 1 or 2% here and there will be there, but ultimately from there we are expecting the polymer should inch up from here on. So maybe last quarter, Q4, the bottom will be there. And from Q1 onward, that is from the next year onward, we are expecting the polymer should start going up.
What sort of inventory losses have you seen this quarter, sir?
I think this quarter we lost approximately 20 crore rupees into the inventory, because both our key raw material, that is PVC as well as CPVC, our company is more focused on the CPVC, both were down. PVC was down by almost 7% and CPVC was down by 5%.
What is expected on that then, sir? If we expect the pressure to continue here, or could we see a revival there, which could then, of course, mean inventory gains could come into the next quarter? I mean, internally, what are you working with in terms of expectations going ahead?
I think historically, you see, Q4 is giving us the fantastic number in terms of growth as well as in terms of margin. So we are expecting that the number should be better in Q4 compared to what we have delivered so far. And once the polymer will start inching up, definitely there will be an inventory gain, because normally on an average 2 months inventory will be there in the system. So we are definitely going to benefit out of that.
Right. So let's talk about margins. Again, healthy margins. I know there was a one-off expense this quarter. You've celebrated your anniversary, so that is significant milestone in many ways. But where do margins stand, and where can we expect margins from Astral going ahead?
I think we have given the pipe 16 to 17% EBITDA we will be maintaining. And as far as adhesive is concerned, around 14 to 15% EBITDA will be maintained. And even 9-month basis, if you see, we already crossed the 17% in pipe. And adhesive also, we are close to about 13.8. So in the last quarter, we will cover up a little bit. So we will be within the range of our guidance of 14 to 15%. 5 may we surpass what we have guided.
Sir, so if I have to ask you about value, I mean, your blended margins, of course, if you can take me through that. And you've also indicated in the past that, you know, you're trying to add more high margin, value creative revenue to your top line. Break that down for us and tell me what is the outlook there, and also for faucets and sanitary business. That is a tough business. Of course, you're a new entrant in that sense. How is that vertical playing out for you?
So I think bathware vertical is doing great, I can say, because we already reached the run rate of 20 crore rupees a quarter last quarter. Previous quarter was 17 crores. So quarter on quarter, we are increasing our run rate. And now slowly and gradually, we have started spending money onto the branding activity also. That is why you can see this quarter, we have incurred a EBITDA level 4 crore rupees of loss. But we realize that the branding is necessary in this segment. So we have started spending on that. So I think first couple of years will always be a challenging because it's a new segment for us. Product, what so far we were there, and this product is completely different because this is the aesthetic value product. So the way of working will be different, and post-sale services is also there. So I think couple of years, once we will understand the market completely, then the growth will be sharp. And we have seen in other products also, the beginning it will be slow, but then once the product get established and you can say the product availability will be there in the system, then the growth pick up very fast. So here also we are expecting the similar kind of growth.
What is the revenue contribution coming in from this business, and also the next maybe couple of quarters or the next year, financial year, what sort of contribution can we expect from this business? And also you said you're spending on marketing. Is that cost one-off, or do you think you might have to incur these costs over the next few quarters as well?
So I think next year we will be clocking minimum 100 crore plus mark. So that is what we are targeting. And marketing cost cannot be a one-off because it's a beginning of the journey. So we have to keep spending some spend on the marketing. But as per the guidance of our board, we will be keep spending the money once the growth will keep coming. So based on the growth, we'll keep spending more money.
So when can we expect that business to turn profitable for you in that sense?
So originally we have guided that at the end of the Q2 next year, we should be a break even. But if we spend little more on the marketing, then there are probability that it can extend one more quarter for the break even.
Right.
Because still the base is very low.
Right. So you will expect to break even in the second quarter of next year. That's what we are working with right now.
That's what the original plan. But at that point of time, we were not planning to spend money on the branding side. But if we start spending the money on the branding, then one quarter can also be extended. But the thing is that branding is not restricted to only that particular segment, because branding benefit available to our other products also. So we consider branding as an investment for the group. It is not specific, but as per the accounting policy, we have to allocate to that particular business also. So sanitary and faucet branding will help the other business also, including pipe and adhesive.
Talking about adhesives and pipes, talk to me about that business. What is the sort of revenue growth there? Are margins healthier than the other verticals? I know that your UK operations did report a loss. So talk me through that as well.
So I think UK was one of that thing. In the last 5-6 years, we have never seen any loss in any particular quarter. This quarter was a normal quarter for that geography, because we lost some money into the forex also because the currency volatility was high. And secondly, we have incurred the sizable loss into the inventory also, because our key raw material, which is we are consuming the highest, that prices has fallen sharply from $8.5 to almost lowest $2.3. So because of that, this was the one of the quarter. But I think from here on, we are not expecting any such kind of loss from the UK geography. And in spite of this loss, I think we are very happy with the performance, because that business has grown 9% in value terms, and volume terms will be even 15-16% plus. So we are happy with the performance of UK. As far as the India operation is concerned, I think India is doing fantastic. We have guided 14-15% margin. This 9 months, we have clocked 16% EBITDA margin. And not only that, we are gaining the market share. That is very important for our company, because in adhesive, continuously, if you see since last 3-4 years, we are continuously gaining the market share. Even pipe also, we are gaining the market share. So that is more important for us. 1% margin here and there, it's fine. But as long as we are gaining the market share, I think we are more happy with that.
Right. So your employee costs at a group level have also risen substantially by over 42%. Now, is this here to stay, or again, is this a one-off? Just trying to understand what happens going ahead to your margins.
Because we are foreseeing the very, very robust growth in the next 5 years. So considering that in mind, I think a lot of new position being created at the corporate level, because we were not having CHRO position. So this year we have created the CHRO position. We were not having the CTO position. We have created the CTO position. Similarly, we have added the new business. There also we have appointed a vice president level of person, whether it is a faucet business or whether it's a paint business, we have added a lot of people. So considering the next 5-year growth, I think management bandwidth is needed for us. So considering that in mind, we have done little ahead, I can say, before the growth. But it was needed because without that, next level of growth is going to be a challenging. So we thought that it is the right time that we should aid our management bandwidth so that when the growth is coming, at that time we should not be having any challenges. So because of that, the cost has gone up.
Right. Also, sir, you've extensively invested in businesses or expansion in the last few years. I want to understand from you, if you have to guide our viewers, and I know you have historically undercommitted and over-delivered, but what sort of a growth are we looking at over the next 2 to 3 years? And what sort of margin improvement can we expect once the other businesses also start contributing positively?
I think margin will remain in the range of 15-16% kind of job. But as far as the growth is concerned, our expectation of growth is high. Right now, we are committing the 15% kind of consolidated growth. But once this, I think, inventory losses or polymer cycle will reverse, I think it can go up also. And new business so far has not contributed. If I talk about the paint has not given the growth to us this year also. On the contrary, maybe a little degrowth. Because we are doing a lot of correction, we are implementing SAP, we just completed that also. We are doing a lot of new MIS, we are correcting a lot of things at the plant level. We are developing new products into the paint category also. So right now it looks that they are not contributing. But once these two vertical, bathware and paint, will start giving the growth, because our base is nothing. And looking to the opportunity available in the market, we are confident that once this business will start clicking the growth, it can be a very, very high growth also, because this segment is very fantastic in India. So I think once this will start performing, it may take some quarter more also, but then I think growth will be much faster. And forget about that, our flagship product, that is the pipe. Pipe, we are at a high scale also, we are growing at a 24% volume. And I'm very happy that once these two new plants will be there, Guwahati has already started. Once this Kanpur plant and the Hyderabad plant will operational, I think then it will be really a game changer for us, because these two geography, we are going to gain a good market share, where we feel that we have to do a lot of hard work over there. So I think all this thing which we have invested recently, it's going to pay us in next 1 or 2 years' time.
Right. Sir, that was, of course, a great indication of what you actually do and what is happening with the company. But very lastly, is there anything that you've lined up in terms of more investments? I know marketing is one cost you're going to be incurring, but any more facilities that you're looking to add? You do have some cash on your books. Any sort of plans for utilization of that?
So I think other than pipe, we have done sizable capex. So now we are going to get the return from that. Pipe is the only segment where we see we can do further investment, because looking to the growth and the way we are getting the reports from the market and the way we are getting the commentary from the developers and all, it looks that even if we can spend more money into the pipe, that is going to pay us in the next 2 to 3 years' time. So once these two plants will be operational, then we will decide where to invest and which geography we want to gain the market share. Based on that, we will decide. But investment is such a thing that we have to keep investing, because the kind of growth is coming to our organization. We will not shy away for the investment. We should be always ahead of when the demand will come. So I don't think investment is the challenge, but our company is very, very conservative. So we will evaluate every investment, and based on that only, we will decide where to invest. But
All right, some news coming in, and in fact, an announcement you would expect in the budget, but it's coming in a day before. The government has cut import duty on mobile parts to 10%. Janani is joining us for more. Janani, give us some details on the notification which has been put out and what the actual purpose is. What is the policy decision?
That's right. So, like you mentioned, this is something one would expect in the budget, but right ahead before that, the government has cut the import duty on mobile parts such as screws, SIM sockets, and other tiny metal mechanical parts that are used in the larger making of cell phones. Now, the standard duty, which was earlier 15%, has come down to 10%. Now, this also comes on the back of a wide expectation that the government would, slash the import duty in order to enable the ecosystem for high-end mobile manufacturing. The likely beneficiaries from this are, of course, the Apple ecosystem, Samsung, who are already part of India's PLI scheme and are also exporting from India. Because if we look at it now, the top export destinations when we import mobile parts, and the one that we are exporting is to the USA, the UAE, Netherlands, UK, and the Germany. So it is expected that the exports to these countries will also be rising. And also we can expect that, other computer hardware and peripherals will also come under the view now. And the government may look to also smoothen the process to enable more manufacturing of them. As far as this goes, the intent is to ensure that the scale of manufacturing in the country is considerably boosted in order to aid exports, large-scale mobile and electronic exports, which is currently doing quite
Absolutely.
well.
You want Make in India iPhones and other smartphones, then you have to give some concessions, and that's the concession which was being predicted has come in now. Import duty cut on some mobile components from 15% to down to 10%. You're seeing Dixon already responding, and if you pull in the chart, you'll see how that bump up has corresponded with a bit of the news coming in as well today. We'll take a very quick break. Thank you for that, Janani. But on the other side, we'll bring in a conversation with Sachin Tikekar of KPIT Tech.
Welcome back to India Market Open, and some expensive stocks I was saying remain expensive because the numbers delivery keeps on coming. Now, until that happens, probably continues. Now, KPIT Tech is one such name. Remember, the stock got hammered for 2 days on a trot because of some selling, but they came out with numbers which looked impressive, as a result of which, after an uptick yesterday, we're seeing some bit of an uptick today as well. Now, we spoke to the management, Sachin Tikekar, on a number of issues regarding the results and beyond. Here's a slice of that conversation.
I think that has been the case for the last few years, to be honest with you, Niraj. And it's not. I think there is just added pressure from the Chinese OEMs now. Our OEMs across Japan, Europe, and the US, they've been making that shift towards software-defined vehicle and electrification for quite some time. Some are further down in their journey, and some are trying to play catch. And that's where we actually come in. And our engagements with them has helped us to sort of grow in a consistent manner over the last few years. Now, the Chinese OEMs are very visible, especially in Europe and some of the countries in Asia and Latin America. And that is just adding a little more pressure on the existing OEMs. So it has actually helped us in the past. And as there is going to be more and more pressure, maybe there are other ways in which we can help our existing OEMs to remain competitive in their respective markets.
Got it. Okay, point well taken. Now, to some client or rather some specific deals or specific accounts, if you will, one of the things that you stated that you've identified 3 new OEMs as potentially strategic, and you expect to see revenue accretion from these going forward. Can you tell us a bit about this?
What we do, Niraj, is we work with, it's our T25 strategy. So we work with T25, and that's been our model for quite some time. And what we do is every year, twice a year, we actually look at refreshing the list, given what's happening across the globe. And usually there are 1 or 2 who sort of, for whatever reason, they are no longer part of the T25, and there is always an opportunity to add 2 or 3. So we always keep an eye on all the OEMs across the globe and keep sensing and scanning which are those 4 or 5 with whom we can engage and create meaningful value for them. In the course of this financial year, there are 3 that we have identified, 1 from the Americas, 1 from Europe, and 1 from Asia. And there have been several conversations, workshops, and some pilots that have been done with all 3 of them. So we do see, at this point in time, what happens is typically it takes quite some time to really figure out what their pain points are and sort of what are the ways in which we can actually build a long-term strategic partnership with them. This is important to us. Just doing one-off projects and programs doesn't make sense for us because it doesn't put us in a position where we can create tremendous value for them over a period of time. So they want to get to know us to see whether we are going to be their long-term partner, and we also want to see whether, is this partnership going to be long-term and valuable, mutually valuable to both. So that's what we've been doing with them during the course of this year. And we believe that there will be some growth that will come from all 3 of them because we'll do some programs and projects with them. Only time will tell whether there will be an inflection point with some of them over the next few quarters. That's hard to say at this point in time, Niraj.
Point well taken. Is the advancement on the middleware piece, wherein you have this JV with ZF as well, you mentioned, I believe, some mentions about commercial vehicle revenues as well. Is that also difficult to call in a volatile environment like this, or do you have some clarity there?
So let's talk about the middleware. The product, it's a separate company called Quarix, where ZF and KPIT are the investors. So it's now sort of taking its own form and shape as a separate entity. And then there are certain legal things that we need to overcome in the next few weeks, but we'll have that in place over the next few weeks. But it's actually come together and it's acting like an independent company. In terms of the development of the product roadmap, it's going as per our expectations. And what it is going to do is going to do two things. One is, as Quarix, the middleware platform, gets sourced by some of the leading OEMs, KPIT will act as the software integrator for them. So there are a couple of conversations that are on the way, where the Quarix middleware has been discussed with a couple of the OEMs. And naturally, if and when that happens, KPIT will be the software integrator for that middleware. So that's where we are on the middleware and the Quarix front. As far as the commercial vehicles is concerned, more than 20% of our business actually has been coming from commercial vehicles, largely from trucks. There is a realization that in terms of technology, there are similarities, but in terms of the business and the applications, they are very different from passenger cars. And what we are trying to do now is really understand the business of the commercial vehicles, especially trucks, and see how we can use our technology to make them competitive or, get to their realizing their strategy. That's the part that we have started to double down on during the course of this year. And we believe that this will bring sharper attention, hence growth going forward. That's one part of the commercial vehicles, which is on highway, the trucks part. The second part where we are slightly behind, but we have started to make some investments in, is the off-highway piece. Whether it's agro or mining equipment, that's going to be, but that to me, it's to us at least, that's a, let's say, a 2 to 3 year kind of time horizon before we start to engage with our clients in a more meanleware manner. So that's the story on commercial vehicles.
Got it. So do either of these, right, with middleware or this thing, have the potency, and that's my last question, Sachin, have the potency to become much larger than what they would be currently, or it will be a steady state kind of a growth that could be anticipated? I mean, again, could there be an inflection point into either of these?
Oh, absolutely. I mean, if you look at middleware, in some ways, I think we are already engaging. So from their production program 26 perspective, middleware can be part of it, but it's kind of, in terms of timing, it usually requires 3 to 4 years of planning. So it's going to be a little bit of a touch and go, but we hope that we'll have at least a couple of production programs for 2026, 27. The real, the 2.0 of SDV middleware, which is expected between 2028 and 2030, that's where there is an opportunity to have that inflection point, Niraj. And the work for that has to start maybe 3 years or 4 years in advance. So that's the answer to your question about the middleware piece with Quarix and software integration of KPIT. On the commercial vehicles, yeah, that's absolutely the effort. We want to make sure that we look at, we believe that the passenger car business will continue to do well in the foreseeable future, next 3 or 4 years. We'll need another growth engine to supplement that beyond, let's say, 27, 28. And we believe it, natural sort of adjacency for us is commercial vehicles, where most of the technology becomes relevant. It's just that the business applications are different. So first with trucks, because we have existing clients that are already part of T25. For off-highway, there is more work to be done.
Got it. Time runs by. We haven't discussed Renault. We haven't discussed anything else that you've done recently, but, well, maybe we'll save that for the next quarter. But Sachin Tikekar, thank you so much for taking the time out and speaking to us. Appreciate your time and all the best for the quarters ahead.
Thank you, and it's always a pleasure, Niraj.
Likewise, Sachin. And viewers, thanks for tuning in. Yep, and I'm glad we had that conversation because the stock has done really well and the markets seem to be doing well too, by the way. I think we're just seeing a bit of a recovery, if you will. Look at the Nifty 50. It's early days, a very small band, but nevertheless, for whatever it's worth, there's a bit of an uptick out there. Now, before we take that break, there is also a new kid on the block that'll get listed shortly, and we'll just kind of mark that as well. So that's the other thing to watch out for. But suffice to say that it looks like a decent start on a day wherein the expectation is that the markets will probably stay sideways ahead of two big events, which is the Fed meeting later today and then the budget tomorrow. But Nova Agritech just about getting listed.
Interesting company, Niraj. It's a Hyderabad-based company which is into soil health, plant nutrition, crop protection. So an interesting portfolio over there. Let's see what the listing price looks like. Remember the IPO market, which was on a red-hot streak through most of 2023, has not had too much of a start in 2024, early days though. But look at Nova Agritech, up 16 bucks, 41 rupees odd was the listing price. You're seeing a 16 rupee pop right at the get-go. And the agri space might not have too many options for investors to look into. A sector which is very high up on policy push as well. So maybe Nova Agritech would be an interesting play. What brokerage report said in terms of a downside was a bit of it was the regional concentration and the geographical concentration would be a bit of a downside. So that is the big listing this morning. But with that, it's a wrap on India Market Open. Stay tuned. We have a budget special coming up next.